Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, it's Phil Tarrant here. I'm the host of the Smart Property Investment Show. Thanks for joining us today. Not really too sure I'm going to go with today with this particular chat. I've been thinking about it over the weekend. If you haven't tuned into it yet, it went up today actually. I did a podcast with a guy called Eric Brown, who's right in the middle of a development in the eastern suburbs of, the inner west of Sydney, a suburb called Lilyfield, and he's having some challenges with it. Go and listen to the podcast, 12th of Feb. He was pretty frank and honest about how he's tracking with this particular development, and I appreciate his insights and his honesty about just how bloody hard it is to get this stuff done. And I think a lot of property investors often get drawn in by the glamour and the sizzle and the attractiveness of being a property developer, but they don't really understand just how hard it is to not only get a project up and underway, but most importantly make a few bucks out of it. A lot of people can go and develop places, whether it's a duplex or a number of townhouses, or it might even be a larger scale development. But often you hear the good stories, but you don't really hear the bad stories. And my sentiments is that sometimes the bad stories are just as prevalent as the good stories, but they generally get swept under the rug. So I've been thinking about this a lot over the weekend, and I want to put a bit of a spotlight onto it, trying to work out where to start with it. And what I thought the best thing would do would actually get someone in the studio who knows about this type of thing a lot more than I do, and I don't profess to be an expert at all on property development. The sort of stuff I do on our portfolio for the Smart Property Investment Show is very much just some really cosmetic renos and stuff, so I wouldn't claim to be a developer at all. But chatting with Eric Brown over a series of podcasts I've done with him, he's dabbling in a particular type of development. He's at the moment trying to transform a warehouse, or formerly I think it was some sort of aluminium window shop into two apartments, and he's having some troubles getting it through council, a lot of financing issues and stuff. So it's not easy. If you want to go into development, I'd go in with your eyes open, expect to go through a pretty serious learning curve. For us in our portfolio, it's something we will get into at a point in time. I feel as though I don't have the time and the bandwidth to really immerse myself into it to do it properly. That said, though, there are some companies around that you can outsource this stuff to, and that's who I've pinned down today to come and have a chat with us. A guy called Neal Ashworth from a company called White Gorilla. Is it Ashworth or Ashworth? Ashworth. So I got it right. Neal, yeah. How you going, mate?
G'day. Good.
Thanks for coming in. So there's a rambling preamble about trying to introduce you into this particular podcast, but rightfully, I think the glitz and glamour of developing property is a harsh reality behind it, right? And it's a hard slog. There's a lot you can get wrong.
Correct.
And it's hard to get it right.
Yeah.
Is that fair?
Well, yeah, there's a lot of people out there who want to get into that development process, but they don't know where to start, don't know where to go.
Mm. You got a bit of a twang to your accent. Where are you from?
I have, yeah. So Manchester, England.
Are you a Manchester guy, eh?
Yeah.
Yeah, there you go.
Originally, yeah.
Yeah.
But I've been here 18 years, so dual passport.
Citizen. So talk us about White Gorilla. So you're essentially a developer for hire. So people will want to do some development, and they'll go, I can't do this, and they'll hire a guy like you in to do it. Okay.
That's right. So I can just show them all the steps of so I develop property for myself, for my close friends and family, and then I can also do it for clients on their behalf. So they can use their own funds. I become like a business for them for hire, and I take them through all the steps that I do my own developments, and I do it on clients' behalves.
Okay. So I didn't bring you in to plug your business. I brought you in to give me all your secrets so our listeners could learn how to be a developer. Yep. You happy to do that?
Yep.
All right. So there's different scales of development, right? So for a lot of our listeners, they might be talking about, buying a 1,000 square metre block somewhere and putting 2, 3, 4 townhouses on it. So let's use that as a bit of a scenario, because I think it's something that the majority of our audience would understand and appreciate, and for many of them that's their goal. So as a bit of a case study, let's go down that way. So what do? You how do you find the right block in order to put a development on? That's probably where most people start, is it?
Yeah, it starts with that search brief. So find the site that's going to perform to turn it into 4 separate townhouses. Once you've done that search brief, you've got that site, just match it with the client's dollar, what they want to spend, and then what the end result is, if it's 3, 4 townhouses, what the timeline is, when that can be completed, and when the client wants that money back or their investment return. And then just put all those pieces together, just that search brief, put it together, and a feasibility study.
Okay, so maybe I'll bring it back even a step. Who should be doing this sort of stuff? Like how sophisticated an investor you need to be, how many properties do you need to have already, how long do you need to be in the game before you can comfortably go about doing this?
Or you can, as long as you've got like the serviceability to take on another loan finance, or you've got the cash to support it. So normally it's the guy that's got the principal place of residence. He's got maybe 2 or 3, 4 investment properties. You can either refinance them, pull the money from that, or just step it up from that investor to a developer.
Okay, and for people that you work with who want to get down this path, what's normally the flashpoint or the transition point where they go from buying established dwellings and maybe doing a reno or whatever and building their portfolio that way to, oh, hang on a second, I actually want to be a property developer? And what normally is that trigger?
Well, it's just because they've been doing it for a few years. They deal with their accountants, their advisors, and they've got the portfolio. It's up to a certain level. They know the rent returns. They know the percentages of growth. They just want to step it up to the next level because they can use that equity. They can use what they've already got, and then they can see how much this next model will bring them in return, and they can add extra properties to their portfolio.
So would you recommend someone that's new to property investing to touch development, or would you say...
Yeah, let them do it for a little while and come back to me later.
Okay. So let's stick with this this case study. 1,000 square metres, 3 to 4 townhouses, pretty common garden stuff. Depending where you're buying, the rules of the game in terms of what properties you can put onto, what type of dwellings you can put onto what property. So what would be that first step when you're assessing a potential development site?
Just knowing the controls, the development control plans, the overlays, the height limits, what that floor space ratio is for each of the sites, knowing what you can put on that piece of grass to know what you can spit out and sell at the end. And then that forms, you can buy this for 1,000 square metres, you can build 4 in it, they look a bit like this, you'll sell them for X, and there's a profit margin. Do you want to go ahead?
And when you're looking at a particular block of land, whether it's got an existing dwelling on it or there's nothing on it, you're carving it up. Will a council give you the go-ahead to do something before you actually acquire it? Would a council normally only say, yeah, we'd be happy for you to lodge a development application on that basis, but we cannot promise that we will approve?
You don't go that far because you know the rules, you know the controls already. That's why you've picked that search for that area, because you already know what you can do. So you've got a pretty good idea that that site can be developed. So you check it with the architects first. You check what can be built. You get that nod from the architect that that's the design intent. That's what you think you can build it. And then you do all that before you buy it. And then you try and get that long settlement so you can do that design process and get it submitted.
Okay. So a council will never give you 100% guarantee that you can do stuff. All right. So there's a bit of a risk.
You have to go through that process, but it's that the risk and the just knowing what you can do by the history and the consultants that you put together at the beginning in that study.
So again, the same scenario. What sort of team should you be putting together when you're doing development? So obviously, Mr. Investor, say it's me. Who do I need within my team of people to give me the best chance of, number one, acquiring a block of land that I can develop, and number two, maximising the assets I can put on that, and number three, having some sort of realistic financial outcome which is beneficial to me? Who do I need?
Well, just number one, your own financial planner advisor, to know that you've got the capacity to do that. That's in your plan, where you can pull funds from, and then what structure to set it up in, what's best suited to you and your conditions. Then you're all set. Then that gives you dollar, search brief, timeline. Then you could come across and get me on board. Then I'll get the consultants on board, which is architect, surveyor, everyone to take that process through.
Okay, so you'd be like a project manager, right? You manage all the different
client
components.
Project manager, that's right. Then
through.
I'll put all those consultants together.
Okay, so you're like a spreadsheet guy who does Gantt charts and just has everything intricately mapped and managed. Yeah,
correct.
Okay, so investor, guy like yourself who can project manage, an architect. So an architect, for a lot of our listeners that don't understand the development process, you would bring an architect prior to... Would you bring an architect before you start looking for the block, or you need the block before you can actually get an architect in to say what you can do with it?
Well, I've got different architects for different areas, different zones. So if the surgery is for that area, then I'll pick the architect saying, I'm thinking of buying this, double check what you can put on it. He'll give me a quick once over of, I think you can do this, here's your design intent. So he's on board early because he knows more of the controls.
Okay, and the controls thing. So you would have an architect that is familiar with the particular area that you're investing in, and therefore they should know how wide it needs to be, how deep it needs to be, what the height restrictions are, what zoning it is. So pretty much you're getting all the benefits of someone's expertise that's done multiple developments in that area
early
beforehand.
On before you buy it,
and potentially knows the people within council that would be approving a DA. Okay, so that's important. So you I want to develop. I want to produce a development in a particular area. I get an architect in and say, this is the sort of stuff you can put on. Then you would go out and look to secure that block of land.
Site,
which might be private treaty, or it might be via an auction, or however you choose to buy it.
Yep. However it's going to be sold, try and get it prior to auction. Try and get rid of that auction campaign boiling pot, and then secure at the right price.
Okay, so once you settle on, so from when you buy a place, say you buy a private treaty, you buy a place and it settles, gives you a number of weeks to get stuff sorted out. So what should you be doing during that period of time?
So in that time is getting those plans and engaging the architect, plans and permits, getting all that paperwork together ready to submit, and also getting your finance to get ready for settlement. And if you pick a bank, you don't submit your plans before get the loan. But if you go private lender, you can do all that early.
Okay.
So there's just little tricks and how to do that for the best outcome.
So often you might sit on a block of land for a year or more waiting for a development application to be approved. Do a lot of investors actually look to secure a block that might have an existing dwelling on it that you can keep rented out?
So you have that in that feasibility. So you just go $450 a week rent, whatever it is, and that's in the plan for that 12-month period.
Okay.
You can speed it up by buying something that's got plans and permits already approved. So that speeds it up by 12 months.
Okay, so often you can actually buy a block of land that someone else has done the hard work in terms of the DA.
But then you don't get as much money because you're giving those guys that profit. So the ultimate is to buy your own site, you design it and go through that full cycle. But if it speed it up, buy it with plans and permits. And then you can get your finance a lot quicker and start building straight away. So like a 12-month process.
Okay. So, and it depends. Some people might want to move fast or less. So
that comes out, that's client search brief. What do they want to do? How do they want to see it?
Okay, so I got a block of land. It's mine. I've got my design, development application in with the relevant council to wait for approval. I just wait, right? I can't really do much else. I can't start doing any works on the block.
Just leave it until you get approval. Yeah.
Okay.
There's a lot of back and forth in that time, which I take care of.
Yeah, and I think when we spoke to Eric Brown on the 12th of Feb, he's right in that middle of that back and forth right now, where he's struggling to get his DA through, and he's been rejected, I think, once, maybe twice, and he has a number of steps in place to push it through to a development application. The final one of those steps, and most expensive, is the Land and Environment Court, which is where you want to try and avoid going there. So if you can do a lot of the hard work prior to purchase during the search phase and actually understanding the council's requirements for developing particular blocks, it can be a lot simpler. Yeah. So it doesn't need to be a huge headache, but should you expect it to be a headache?
Well, you make sure all that what you design, you're not going to go down that avenue. You know you're going to get it passed, and you don't push the limits. You just design it correctly get it approved and to get the maximum sale.
Okay. So for listeners that aren't that familiar with the development process, so you get your DA approved, and that you normally get notified in the post, probably a big yellow envelope that says, Mr. Tarrant, we've approved this. Yep. You're good to go.
Yeah.
What happens then?
Well, then you've got to open up those documents to make them a construction set of documents. So the council just approve like the overall design. Then you've got to do tender docs to put it out to the market, and construction docs so the thing can be built. Okay. So then there's a tender process. Then you go out to the builders, interview the guys, sign that builder up, sign up to a contract with a timeline, and then manage that build process.
Okay. And what sort of contracts are typical when people are doing residential developments? So sort of these three,
the two HIA or the master builders, really.
Okay.
Or you can go down the route of AS 4000.
Okay. And normally a builder will give you a fixed price or cost plus, or
no, you want to be a fixed price contract with a program timeline with all your schedules and all your fixtures and finishes already in that contract. You don't want to be doing any cost plus.
Okay, so a fixed price contract, that means irrespective of what happens, whether it rains for a month or...
all those things are in that contract. You say the rain days, you say what's going to happen, all in that paperwork before anyone starts.
Okay, and for people that aren't confident dealing with legal contracts, that can be quite a scary undertaking for them. What should people be looking for when they are looking at sort of a building contract? Because that can be very confusing.
It goes back and forth again a few times because it's all geared. The HIA and the master builder is obviously geared to the builder, so you've got to go with your solicitor back and forth. What can you change, and you just negotiate, change it, then you all agree.
Okay, so you get a builder on board, and everyone's happy. You sign a contract saying we love each other at the moment, and we've both got the great intent to make this a nice, easy, simple process.
Yep.
Further down a path might not be that way, but what happens then? So do you get the bulldozers in and start working?
Have a demolition party.
Okay. You have to have a demo party, is that correct?
Yeah.
Case of VB.
Yeah.
Yeah. Smash down the walls, have some fun.
Yeah, definitely.
Well, it's probably a good point, right? We'll touch on it later. You know, this is obviously very serious what we're talking about.
Yeah, and then you can enjoy the process too, right?
Yeah. So you got to enjoy the process, right? So you start the building process, and if you've got your contract correct, it should be drawn out over a period of time. So every week there should be milestones that take place.
Correct.
Yeah.
So when the slab's poured, you go and inspect, you get all your sign-offs, and then you release a payment on works completed.
Okay.
So one of the biggest risks is that builder, he goes under, or something could happen, but you don't release funds until there's a line in the sand every time. You got your paperwork, engineers sign off, the services guys sign off, and then you release payment.
Okay, so you release payment when they've built up to a particular point, and then if there's any problems in the solvency of that business, they go under. It means you've paid for what you've done, and you can bring another builder to finish
and then
it.
the next guy, the builder that wants to come along, he's got everything that he's happy to take on because it's signed off, and there's still money left in the pot for him to complete.
So one of the biggest dangers or issues that you hear from people developing is that builders sort of go under, or they have cash flow problems, they can't complete a build for whatever reason. How prevalent is that? Does that happen a lot?
It does, but then you do your checks in that tender process. You do your go out to the market, tender process, that goes back and forth. You select that guy that's got the history, he's got the workload, you see what he's doing for the next 2 years, you check his insurances and see where he's at and where his business is at and where that risk is before you engage him.
Okay, so you can mitigate a lot of the risks. Yeah.
So in that tender process too, the guys that you're hard with, they'll fall off and go to one side because you're too hard a client. So then you don't want those guys anyway, so it's a good process to go through.
Okay. And don't always go with the cheapest builder either.
Yeah. So in that process, whilst he's doing the work, if you get what you want, he gets what you want, it's all in that contract. You've given him enough information, he's got all his stuff, there's no questions, then he's happy, you get a good product, finishes at the right time.
It's good for him because he can go and
start his next one, earn money in this one, you earn money, and you get a good product. It's a good relationship.
And for people who, not a lot of people are going to develop in cash, so most people are getting some level of debt. Yeah. So they might have debt on the land, and then they might have construction finance to facilitate the build phase. So how involved do lenders get? I imagine they want to see a watertight building.
So you want
contracts.
those guys in early. So if you go on a private lender, you get the private lender in when you buy the land and let them know you're going to develop. So then they're ready for it. But if you get a bank, then it's just different because then you have to buy out the first mortgage to do the construction finance. So it's a little bit messier further down the line. And you can't put your documents in as quick because it's a different loan. So you get those lenders on board early whilst you're in that search brief. So then you know exactly what those interest payments are, so you can put it in that feasibility study.
Okay.
Because you need those guys to service and provide those funds, so get them in early.
And what's sort of lender appetite for these small residential developments these days? Is it up there, or are they sort of...
There's guys who do a certain dollar bandwidth, and then there's different lenders that do a different bandwidth, so you choose that right lender for the right product.
Okay, so you get your builder in, and he builds your townhouses to a point where everyone's satisfied. So you're satisfied that you can actually either sell them or lease them out. Yeah. The lender's satisfied that the job's been done, and they're happy to give the rest of the finance. Yeah. What happens next?
Well, project's complete, and then you either, depends on that client, he wants to sell them all, so you do a slow release auction campaign and build that excitement and sell the biggest one last. But then if that client wants to hold two, sell two, then that's the process, and he leases those two out, and that's how he builds his portfolio. So he buys those sites at cost, but then he's got an asset of the market. So that's good if he holds two, sell two, just to grow his portfolio that way at cost. So that's a good model for that, for him.
And when do you work out whether to build these as stranded assets versus just...
Well, they're all Torrens tiled.
They're all Torrens zone.
Yeah, so you split all that up at the beginning, because that's better for the banks too. So if the banks see it as one line, then it's not as attractive. So they want that split up, so their risk is divided by 4 or whatever the division is. Yeah. So it's better to split up, and you get more money at the auction.
And can you get different lenders to finance different builds then? So could one lender construction finance 2 of the properties, and another lender could not really keep it all together? Yeah,
paying too many fees, and it's too messy.
It does. So we've just painted a really quick visual picture, I hope, for our listeners around developing. So we've spoken about a case study where, buying a block, 1,000 square metres, and putting 4 properties onto it sounds easy. Sounds like there's lots of moving parts. sounds like a nightmare to manage. Where do you see these things going wrong the most? Which part of that process is the biggest danger for investors?
Obviously, the market changing, but that means everyone's in the same boat. But each of the points when you're doing the full cycle, there's always an exit strategy. So you've always got the land, you've always got that asset, and then you can do plans and permits. And if something changes, you can sell the land then with plans and permits. You build it, you plan on keeping them, then you can sell them. So there's all those. So once you've got the finished product, then you either sell it or you lease it.
And working with your clients through this process, you obviously got lots of experience. Where does that break down? You know, if you ever have a breakdown in communication with someone that you're operating on behalf of with the development, where does that normally happen? I assume it's investors not knowing what's going on, or it's an education piece. Is anywhere in particular?
No, it's been all right, actually.
Yeah, that's okay. Yeah.
Yeah.
And the people that you work with in the past they've gone about creating some pretty good assets doing this sort of thing?
Yeah, they've just purchased it, secured it, carried on. They just carry on with a normal job. I just report in with them with the feedback to the client and just give them the updates at each stage.
Okay, interesting. And when you've spoken to people about potentially doing a development, have you often said, no, it's not ready for you, you're too inexperienced?
Yeah, if they're not the right type of client and they're not ready for it, they've got to have the appetite for it and know what it's all about. And it's not the big Meriton high-rise stuff. It's just geared for what their risk appetite is for.
And what do you recommend is the best way for people to hold? I know this is general in nature, this particular podcast. We're not giving any particular financial advice, but how do people usually hold these assets? Are they in trust structures, or they own them individually?
No, it's either PTY, or they set up a new PTY for that particular site, or a trust. That's right. So again, it's their advice, but really most people do it in a new PTY or a trust fund. And
often, we've got some blocks of land sitting in our portfolio that we will do something like this in a point in time. The reason why we acquired these assets was for this particular reason. But often you find a group of investors will pool resources to undertake a development themselves. So rather than one investor owning a whole block and undertaking the whole thing themselves within the trust structure, often you might get sort of 3, 4, 5 investors sort of pulling up and coming together. So how do they typically structure that type of thing?
So again, they'll structure it on how they invest on their side of things, but then everyone will just tip money into a pool, into a trust fund or a new PTY again, and then they just, again, it's written up with dividends, what they own a percentage share then of that business or the unit share trust. They'll own those percentages, and that becomes a trading entity, and then we'll purchase the land in that entity, and then it all goes through that.
And then the process, it's the same
It's exactly the same,
Yeah.
I manage it on their behalf, report back to the investors, the bookkeeper reports back every quarter, and it's all written contractually.
And often if someone goes down that path and structuring it that way, there is a guaranteed end point. So everyone says, yes, we will sell everything at the end of it, or
there's that agreement.
We'll keep one.
Yeah, and if something happens along the way, they'll be written. So if investor 1, something happens and his estate wants to pull it out, they draw a line in the sand, value that where it's at, value that PTY, what's in the pot, give everyone the money back on paper, then somebody has to buy it back in. So there's all exit strategies within that structure that's written.
And if you have a number of investors banding together and creating some sort of unit trust, it's a unit trust that owns the assets, not the particular investors. So is it hard to transition them to individual sort of titles and individual ownership? Is that a difficult thing? Just imagine as a sort of stamp duty or some sort of tax consequence.
No, you do it when you do that design with the council, you split it all up at that time.
Well, it's complicated stuff.
It's good fun.
Yeah, it is good fun. So Neal, we've painted this picture of undertaking development, and we used a very base case study, which I think is probably relevant for most of our listeners and easier for them to understand and see. For someone considering undertaking a development, and nothing too significant, just something quite small, how do you know you're ready for it? Like, if you're going to sort of inwardly look and go, okay, I like the idea of it, but do I have the time to invest in it? Do I have the financial capacity to invest in it? Do I have the nous to invest in it? Do I have the right connections to invest in it? How do you know you're ready?
I say to each of the clients, investors, just go and sort your own, go and see your financial planner, your advisor, just to see where you're at with all the stuff that's going on, and then what you're going to refinance, where you're going to get the money from, timeline, get all that advice ready so your stall is set and you're ready for it.
All right. I'm going to put a lot more focus on this in the future for our listeners, and we've been getting a lot of feedback recently. I think they've liked those couple of podcasts we've done with Eric Brown, the last one, who's sharing his story developing on the 12th of Feb. We'll do more of this, and keep the questions coming around. Is there anything specifically you want us to answer, or anything you want us to ask people who are currently doing this, whether they're like Neal and actually work in the game and I imagine charge a service for it, that's how you make your money, or developers themselves. We'll get them in the studio and find out, because the market is changing at the moment. You see a lot of transition in property prices, and particularly in Sydney and Melbourne. Everyone's been talking about a softening of those markets for quite some time, and now we're starting to see a little bit. Look, it's still moving along quite nicely, but I won't go into the data and analytics around it. It changes all the time. But for a lot of people who have secured good assets over the last number of years with development in mind, and maybe coming to a period of time when it's starting to make sense to look at undertaking those. And as Neal's spelt out, you might be sitting on a development block right now, but it can still take upwards of 12, 18 months to get your applications in, Neal, to even get going. So, nothing happens fast when you're developing, right?
Right, as long as there's a plan.
Yep. All right. Well, Neal, we'll get you back on, and we'll get some questions answered specifically from our listeners. So if that's you, email the team editor at smartpropertyinvestment.com.au. We'll get back to you and get them answered. Also, we write a lot on development. If you just go to smartpropertyinvestment.com.au/development, you'll see all the stuff that we are producing around developing residential property. Something sort of running hand in hand with this, but also adjacent to it, is a lot of people who buy off-plan apartments. We're talking about something very different here. We're talking about undertaking this work yourself and realising the benefits of the risk you take in developing. And hopefully, you want to get a good return on this stuff versus buying off the plan where you're buying off a developer. So you're at the end of the process. So obviously all the hard work's gone into it, and developers obviously made their money. So just quickly before we leave, Neal, and people like numbers, to actually do a development and make it worth your while. So we're talking the same scenario, 3 to 4 townhouses on a 1,000 square metre block, if your council allows you to do that. Going into it, what sort of percentage should you be looking for as an upside on this? I know it's hard to work it out, but it's got to be under 20%. Just don't worry about doing it.
Yeah, that's right. 22% and above, 25% would be great and above.
Okay.
So it's just getting a bit tighter, but 22% and above. So just like that example is, $1 million land, $1 million build, 3.2 sales, something like that is what you want to look for.
So you want to have at least 22 to 25% upside benefit, because you always got to be ready to cop it on the chin if the markets change.
You do that percentage, you stress test it and do the percentage up and down and see what's comfy.
And what's the easiest thing to control when you're doing a development? Because there's a lot you can't control, like the market or interest rates or whatever.
The contractual side of things, what you want to see in that end result. What you can't control is that timeline from the council. But to help with that, you design everything that you know is going to get passed, and that's what they're happy with. So you just keep within those controls. Everything outside that is just normal commercial negotiation.
Okay. And from what I understand with developing, your architect's pretty important. If your architect knows the game, knows the council, knows what gets passed easy, it can speed up things considerably in terms of your DA, financing, etc., and save you quite a few bucks as well. So how do you know if your architect's any good? Because a lot of them tell you they're good, but
so you have to go through a few and get your chosen few for the right area, for the right council, for the right site, style, budget.
So if you're going to look at 2 or 3 architects, what would be the 3 questions you'd ask each of them to make sure they're right for you? See
how many times they've been to either land and environment, look at all the projects that they've got through, what was their timeline, get that history from them, what they've been knocked back for, and do the grill them to see how well they perform.
So if they go to land environment court, that's bad.
Well, they might want to fight it and win,
okay,
because they know they're right. But really, you want that strike rate from those guys to see how many designs how they started, and what the end result was, and what was the changes through. If it was more or less the same throughout the process, they know the rules, controls, they're in tune with the client, and they produced what they first started with.
Okay. And would you ask them how they're going to charge you?
Because you need to know all at the beginning. You need to know that when you first start, correct?
And how does an architect normally charge you for a development?
Most of them do the percentage on the end cost, but then I'm not interested in that, because then they'll design away the end costs will go up. He gets more money. So again, just part of the feasibility, you want those fixed prices from everyone, so you know what you're in for when you start. So fixed price from everyone.
So an architect will want percentage, because then if they make a real fancy joint, they get paid more money. But then it might not be conducive to the area that you're doing it in the market.
So you've got to control those consultants and keep them on your side.
Keep them on their toes. And that's why a lot of people sort of just go straight to you, right? You look after all that sort of stuff. Yeah. So, all right, Neal, mate, appreciate you coming in.
Indeed.
I haven't checked out your website, but I'm sure it's got a lot more info on it. What is it?
whitegorilla.com.au.
Well, there you go. Quick plug. But no worries, mate. I do appreciate it, and we're going to get a lot more into this over the period ahead as well. So do get in contact. If you're not subscribing to our daily morning market intelligence, being the first to know what's happening in property investment, also development, smartpropertyinvestment.com.au/subscribe. If you like social media, and that's how you get your info, just search Smart Property HQ. You'll track us down. And please, keep tuning in. We've had a massive increase in listens over the December-January period. We're now sort of middle of February, and it's blown me away just how engaged this podcast is now. And I imagine a lot of those people sitting around on the beach, I hope, drinking pina coladas and listening to the Smart Property Investment Show, thinking about the future and how they're going to create wealth through property. So keep at it, keep with us, and let us know what you think. Until next time, we'll see you then. Bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.